Hey, this is Jose Blasco. How are you, everyone? We are about to get started. Let's have a quick sound check, as we always do before we start the session. A quick message on the chat box would do, as always. A quick hello, a quick anything nice you would like to type on the chat box would be appreciated. So apart from nice, now I know you hear me, so we are ready to get started. So please go ahead and say hi or any other message that you may want to have out there for the community. In the meantime, I will turn on my video stream so I can say hi from the bottom right corner of the screen, as I always do. How are you, Christian? Good to see you. How are you, Maka? Good to see you all. And here we go. We are live, my friends. We just hit 00 in the countdown, so it's time to go live. May 27, 2021. Welcome, everybody. This is Options with Options. We're going to be spending an hour looking at the markets, identifying options opportunities, and basically putting those trades in place, executing them, review trades that we have, look at the market, understand the market conditions, and all of that and more. Before we get started, as always, I would like you to read carefully the disclaimer on the upper side of the screen. This is important information, so please read it carefully. I am counting on you to read every single word, not to skip any sentence or paragraph. Just read it carefully. It's important stuff. It is relevant, and it's not there only for legal purposes. It's definitely, as I said, relevant. Trading implies risk, and therefore, especially if you are new to the sessions, okay, it's important for you to be to understand well the risk involved when you put money in the market. Okay. Anyway, agenda, we're gonna do a quick hello to everyone, which we have already done, and I thank you very much. From there, we start simulcasting, so we are now broadcasting in multiple places at the same time. The sessions are happening in our private room that you can access from our website, tradewithufos.com/live, but also the sessions are simulcasted to places such as YouTube, Facebook, and so on, public streams if you wish, and therefore everybody can access. The ones accessing the sessions in our private room are our coaching plan members, which implies a subscription on our website. You can take a look and find out more about that on the website itself. And for the ones of you watching us from YouTube, Facebook, of course, these are public streams, so it's free access, even though the duration of the sessions is less, okay, which obviously makes sense. It also makes sense because we think of our community as, let's say, two groups of traders. Some of you guys are what I call part-time traders, looking at trading seriously, but you are okay, you get enough with a little bit of training and support, and that's it. Where some of you are, those super passionate traders, people like me, for example, where we always want more, we never got enough, we love it, and for those, then I certainly recommend that instead of attending the sessions from YouTube or Facebook, you go ahead and you attend from our private room in our website, again, tradewithufos.com/live. How are you, Joanne? It's good to see you. It's good to see you all. Wonderful. And basically, so we're gonna start now. We're gonna review the markets. We're gonna understand the market conditions. From there, review the trades that we have running. We may have some work to do today with some of the trades, as we saw yesterday. And from there, we'll get into finding new opportunities. So with all of this said, we are ready to begin. And here we go. Here is TradeStation. Here is the S&P. And what is happening today? Well, the market is going up. But that's not a surprise because we knew the climate is up, okay? What is more relevant really is the fact that a new green UFO just formed, and we know sell on field orders in an up climate tend to be cancelled. But on top of that, we also know that in an up climate, buy on field orders tend to be added, which is what just happened. In other words, the market is positioning itself very well for another breakout to the upside and start making all-time high again. It's possible that the market reacts to this red UFO when it reaches it and then comes back down to this green UFO, and from there, that's when the movement will happen, okay? So we'll have to see, but so far, when looking at the climate, it's 5 out of 9 confirm and blue, so everything is pointing at the S&P to continue moving in the upwards direction. When looking at the VIX, really the VIX confirms that. I was looking at the VIX a bit earlier today, and yes, it's still the same. It's minus 2% down. It was minus 2.5% earlier when I was checking. So the VIX is down to 1698. Got into this green UFO, and now what's likely to happen is going to be a little bit of a bounce on the VIX. Okay, that's what's likely going to happen. And this may coincide with a little bit of a pause or retracement in the market. So definitely, if you didn't guess it, with this type of market condition, so number one, it's either we're going to do non-directional trades in the form of positive vega positions, as you saw in the past few sessions. The double calendars are trades that provide plenty of positive vega. So we'll certainly look into that. But also today, actually, I would like to start by being directional, because it's also a very good time to buy options, okay? Just buy calls, buy spreads, because the price of those are quite low. And with the green UFO likely going to increase, and with our analysis of the market, where we may have an all-time high situation. So if we find any of those, would be delighted to be in those trades. If you recall last year in 2020, we had a few, I would use the word fantastic, okay? We had a few fantastic trades, okay? And those were taking advantage of an all-time high situation where, the market rallied, amazingly. We had trades that perform like, I think it was like 800% return, basically the calls that we bought multiplied times 8 their value. I mean, we should not expect every trade to be like that. Those are just a few, but certainly when the setup appears and the market conditions allow you to position yourself in this way, so certainly we want to at least try to get those trades in, so then we can participate of those moves. And this is exactly what's happening. So we have green UFOs below, the climate is pointing up, we may have an all-time high situation soon, and implied volatility with the VIX, it's very low in a green UFO. So it's exactly everything we need to get ourselves in these type of trades, okay? So that's why today I'm gonna start with the directional trades instead of the non-directional. But before that, we need to review what we have, okay? We'll start with TIM, okay? So what's happening with TIM? Well, TIM is down by 1.03%, okay? Funnily, the market is up, but that stock is down, which it's pretty good, actually. Why is it good? Because when we look at OptionStation Pro, okay, if that stock had gone higher, notice how the upper dotted line is very close to the solid line. So if that stock had gone higher, probably the upper dotted line would be surpassing the solid line, okay, probably. So then a roll will need to take place, okay? So I'm just gonna move to TIM, okay? Okay, equities and indices. How are you, Formon? It's a long time. I didn't see you around. It's good to see you, my friend. So we are looking at the analysis tab, okay, for that particular iron condor, and we can see that probability suggests, okay, that we're gonna move from between 249 to 209, more or less. So if I was to adjust my line, so 209 is more or less what it is, and I think I said 249. It's somewhere more or less there, okay? So in other words, it's looking like we're gonna be in the range for a little longer. And the beauty is that we now have a new red UFO that we didn't have yesterday, if you recall, and now we have it. So again, we are back to 2 UFOs above, 2 UFOs below. So looking very good for this trade to continue accumulating time decay, which is what we needed to do. Now, let's say tomorrow, we're not going to be together in the session, okay? But let's say, just so you know, let's say tomorrow, that market gaps up intensively, and next thing you know, you look at stats and the dotted line, instead of 249, is actually above the solid line, okay? So you guys tell me, what would you need to do? Because you're going to have to do that by yourself, okay, if that's the case. How are you, Ahmed? How is Siderman? Good to see you. So what would you need to do if the upper dotted line surpasses the solid line? What would you need to do? Anyone? You guys go ahead and type it on the chat box, okay? because this is a homework that you will need to do by yourself, okay, if that's the case. Okay, I'm just waiting for the responses. This is where the video lags, depending on where you are, okay, you know, gets a bit tricky to get the answers on time. Very well said, Maka, very nice. We're gonna roll the puts, okay? So let's pretend that the setup is something like that. So we have, you know, 255 and 209. So then what you would want to do is that you would want to use the first UFO beyond the dotted lines, which is this one, okay? And therefore, you would close the 180, okay? And depending on what's available, so let's take a look at June 18. So below, we have 202.5, okay? So let me see. So we have $10 strike price increments, 190, 180. 202.5 would be the one. So if we have 202.5 and then we don't have 192.5, that doesn't exist. So then probably the best way to do it is to do 202, actually to do 200, 190. Okay, so you would roll $5 higher, okay, and change the 190, 180 to become 200, 190. So you roll it up, which would imply locking in profits from those two puts below and selling options at a higher price, which means collecting more premium for new options that are closer to price. And that way, you know, you would start offsetting a little bit the pain if that stock was to break up to the upside. So that would be the plan if this happens. Hopefully this is well understood. If it's not, make sure you let me know. But so far, this action is just a what if situation. We don't need to do any of that at this moment in time. Christian, I'm seeing your answer as well. Move the puts up. Yes, that's the answer. Very well. So MasterCard, okay. Again, I didn't look at TOS, okay. So Team is currently providing $112.5 here. So if we look at MasterCard, which is right here, it's also showing a positive P&L. This is also an iron condor. You can see all the dates are the same, June 18. Okay, so we have this trade here, and also MasterCard. Actually it's a little bit higher than yesterday. It's 0.63%, but you know, really, you know, I would say even lower than what it was when we looked at this trade yesterday. So it's looking good for this stock to stay in the range between 249. Sorry, let me rephrase that. 388 and 343. So 388 is more or less here, and 343 is more or less here. Okay, so something like that. So in other words, all looking good for us to stay in the purple area and nothing to be done. Plenty of UFOs above, plenty of UFOs below. So we should be pretty okay. Can we look at expected move instead of standard deviation? Well, that's the expected move, Maka. You know, I mean, if you are talking standard options terminology, the expected move is based on implied volatility, and implied volatility is basically representing a one standard deviation of price movement. So it's actually the same thing, expected move and one standard deviation as a projection, okay? You could certainly project the price movement based on historic volatility. That would be a different calculation. But the one that is being done here by TradeStation, it's based on implied volatility. Okay, so that is the expected move. Okay, if I didn't get your question right, please rephrase it if that's okay. So EM in the option chain. Oh, here, that number here, yes, is the same. Yeah, is the same, or should be the same. Is the same. Okay, very good. There may be a little bit of a difference because now that I think about it, this number it's calculated with a delta weighting. So that number here is calculated very similarly on how the VIX is calculated, where the at-the-money strike is the reference, and they take 3 strikes above, 3 strikes below, and the weight implied volatility times delta. And therefore, then they do this weighted average of the implied volatility, and then they calculate the expected move. Okay, so this is how it's done in the option chain. At least this is how years and years ago I advised TradeStation to calculate it, and I know they programmed it like that when they were developing TradeStation Pro. They may have done changes through time, but this is how it should be calculated. And to be honest, okay, even beyond that, I will say that it doesn't really matter how it's calculated, even if you were to use historic volatility as the foundation for this calculation, which, to be honest, I don't dislike to do it with historic volatility. It would still be okay. Okay, why? Because the idea it's not to be precisely right. The idea is just to quantify in a way that is consistent and that is objective, some sort of a measure of the risk of ending in the range or not to end in the range. And we don't have a crystal ball, so we're not going to know for sure. So the key is to have a mechanical way to assess that. So if your mechanical way on how to assess that was to put the dotted line beyond the solid line, then you act. And therefore you act based on a mechanical process. So there is no emotions involved, there is no a human impression like it looks like it's gonna break the range. These kind of statements that, you know, it's easy for us to kind of build those thoughts in our mind. So we want to kill those thoughts because that's emotional trading, and instead use a mechanical way to assess, is it likely that I'm gonna stay in the range, or is it not likely that I'm not gonna be in the range, okay? That's it. You may tell me, you know what I do is an ATR projection, and I project the ATR above and below. Or maybe you tell me, I use a Bollinger Band in the weekly. Or you tell me, you know, I use a, Kellner channel, which is based on ATR on the weekly. Whatever. As long as you have a mechanical way to assess, I'm likely going to be in the range, or I'm likely going to not to be in the range, now you have a rule on when to act and start rolling and tweaking your non-directional trades with no emotions involved in the process, okay? So, I sometimes use implied volatility, and that is indeed when I use TradeStation. I sometimes use other metrics when I use other platforms, because each platform does those calculations differently. And I remember when I was, and I'm sorry to make this long, but it's important, at least it was for me, when I was in learning stages, and because of my background in engineering and all of this, so I was very kind of like, very inclined to try to find the best method, the best way, the way it should be done. And basically throughout the years and experience in trading, you realize that there is no perfect way because there is no crystal ball. That's the only perfect way. So the key is to have a process which makes sense, which is quantifiable, which doesn't get you thinking and get emotional, which is either black or white as a conclusion. That's the key. And a process that may be better, or you may call that process is better, well, guess what? It may be now or next week, but maybe not next month, because things change. And just like implied volatility at times is too high and therefore it doesn't represent the reality, then sometimes it's too low and it doesn't represent the reality, and sometimes historic volatility is too high and does not represent reality, and also at times historic volatility and does not represent the reality either. So it's not about the reality because we don't know the future, it's about that mechanical approach to a triggering condition that tells you time to act and roll, or nothing to be done, no time to act. Okay? Long explanation, Maka, but this is a very good question, and indeed it's a very important point. So hopefully this addition it's helpful to you, my friends. Anyway, so this is MasterCard. Then we're gonna look into PayPal. So PayPal yesterday, if you recall, PayPal is a double calendar. So we are using July 16 combined with May 28, and yesterday we took the put, the May 28 put yesterday, we took it and we rolled it. Okay, we rolled it to June 4. So the question is it time for us to do it with the 260 call or not yet? Okay, so let's take a look at PayPal. Let's see what's happening. It would be great that PayPal is going down, because that ideally will bring the call to be back out of the money, and it is out of the money by just a few cents, okay, because it's the 260 call, so we are just out of the money, just right there, just out of the money by like 15 cents or so. Okay, so let's take a look at the Greeks and see if we are dealing with fake Greeks or not. So if we look at the 260 call, we have an extrinsic value of 177 with a theta of 78. and we have 1 day and a half to go. So 1 day and a half to go, if you take 78, let's say you make it twice, so 78 times 2 is 150, but the extrinsic value is still more, 175. So in other words, we don't have distorted Greeks yet at this moment in time. Okay, if the stock was to drop a bit, okay, and instead of 259 drops to like 258 or something like that, probably very quickly we would start seeing those distorted Greeks, and then it would be time to do this tweak, to do this roll, but not yet. Not yet, okay? So keep that in mind, okay, that if we don't do it later today, before we conclude the session, I'll review this again. But if we don't do it today, for sure, tomorrow you have to do it, because by the way, if you don't do it tomorrow, I mean, this is a question for you guys. Be ready to answer, and this is important stuff. If you don't do it tomorrow, and you don't roll the 260 call, and the stock is trading above 260 tomorrow, you guys tell me what's going to happen on Monday when you open your trading account. Actually, on Saturday, when you open your trading account. What will you see in there? What's going to happen if you don't close it? Okay, you guys tell me. I'm going to take a little bit of time here because this is extremely important. Even though it's absolutely not a big deal, but it's very important that you understand. So yeah, it would be an in-the-money call. And what happens if you have an in-the-money call into expiration? You get the stock, Joanne, you're right. But you get the stock long or short? What would happen if you are above 260? 100 shares of PayPal. Very good, Siderman. Long or short? 100 shares. You are assigned. Very good. But would that make you long 100 shares, or would that make you short 100 shares? That's the question. Would you be assigned on the call? I mean, it's actually two calls. It's the long 260 call and the short 260 call. You get short, exactly. You get short. You would be assigned on the minus 260 call, and then you would have 100 shares of stock short. Now, for sure, there is a margin implication, right? Because now you need to come up with the money to be able to be short stock, okay? Which probably that's done on margin. I mean, probably not for sure. You cannot be short on a cash account. So for sure, this is done on margin. But question, is that a big deal to be short 100 shares of stock while you own a long call at the same price, at the same strike price, which expired later, all the way to July 16? Is it a big deal? Is it putting on the side the margin required that you need money to be short the stock, putting that on the side, from a P&L point of view, from a risk point of view, you are short 100 shares of stock and you are long a call at the same price. What's the net result? Not a big deal, isn't it? They neutralize each other, right? So think about it. Okay, again, there is this panic out there in the industry, and I'm not saying this is you, but there are many people that panic with assignment and things like that. So if you are long the 260 call, and the 260 call you were short gets you assigned, and then you find yourself short 100 shares. Okay, so what happens? If the stock goes up, up, what's going to happen? Of course, you are losing on the shares, but you are profiting on the call. Correct? And on July 16, let's say on July 16, you are still above 260. So what's going to happen to the call you are long on July 16? It will be auto-exercised. Correct? So if that call gets auto-exercised because it's in the money on July 16, you will become long shares, and because you are short shares, it neutralizes each other. So basically you go flat. Okay? So if it goes up, it cannot hurt you. You just locked in the loss up to today. And whatever it happens, as long as it goes up, you keep that loss. Even though we're going to be working on the put side, which is the bottom side, and the loss will be reduced through time. Apart from the impact of implied volatility rising and all of that. But worst case, let's say nothing happens, okay, and it goes up all the way, right, and you never did anything, so whatever loss you collected to today is going to be locked in all the way until July 16. You cannot lose more than what you lost up to today. That's my point. And if the stock goes down, what happens? Well, if the stock goes down, the call loses, but the most that call can lose is what you pay for it, where the more the stock goes, the more you profit with the short shares. So you are in a positive gamma position on the way down by being long the call and short the shares. By the way, and this is now getting a bit theoretical here, but you need to understand that, my friends, because what we're doing is advanced. Being long a call and being short shares equal what? Equals being long a put. So shorting shares and buying a call is the same as buying a put. It's exactly the same thing. So in other words, if you buy a put and the stock goes up, the most you can lose is what you pay for the put. If you are long a put and the stock goes down, you start making money. And the more it drops, the faster you make money because delta accelerates times gamma. Correct? So now I'm getting a bit advanced here. But hopefully this is making sense. So again, if you were to do nothing at all tomorrow, this is what would happen. You would be assigned 100 shares short. We don't want this to happen. Why? Because then you lock in the loss accumulated to today. Okay, we don't want to do this. We want to roll the call so we have another call that has a further expiration date, and then we are not gonna be assigned shares. But again, let's say something happened to you, your computer doesn't work tomorrow, the internet doesn't work either, you feel terrible, you end up staying in bed. So you can sleep well in bed. I mean, maybe you don't feel well and then you cannot sleep well, but you should not feel bad because you have a trade and you are about to be assigned. That's not an issue because you are not being assigned naked. You are assigned while you won the 260 call long. So that neutralizes the trade. It's equivalent to being long a put. Okay, guys? So anyway, these are conversations that are important to have for you to understand what you get in your hands when you trade advanced strategies, because there are moving parts and there will be situations where you may get assigned, you may not get assigned, you may be about to be assigned, etc., etc. Okay, so the current price for the stock is 259.66. Okay, so it went down just a little more. Let's take a look at what's happening to the extrinsic value. It's 171, 170, 172. Theta is 77. Again, 77 times 2 is like, 160 or something like that. 172 is more than that. So we are not seeing distorted Greeks yet. So we need that stock to fall more, or we need more time to pass. One of the two. Okay. So we'll see if later in the day we can do the roll. And if we don't do the roll later today, the way you would do it tomorrow is like that. You come to where it says 28 May 260 call. You right click if you're using Thinkorswim. If other platforms, it would be slightly different. And you create a rolling order. Okay, and the rolling order would basically have you buy back the 260 call that expires on the 28th of May. You can see +1. So you are buying back this, and you are selling the same option, 260 call, but then you are doing it with a new expiration date, which is 4th of June. Now, if you do that, notice what happens. You will add in $237 of credit. Okay, now you may be like, but wait a minute, but this trade is losing money for me. That call is losing money for me. Yes, it is. How much? It's losing 115. So it's losing 115, and by doing the roll, you're gonna collect 200 over. So what's the net result? You are adding net $100+ into the trade, lowering the net cost basis. Okay, is that making sense, everybody? Okay. That is a long put at 260, Siderman, not 160. It's a long put at 260 because you would be short stock at 260 and you have a long call at 260. So it's all related to 260. Okay, maybe it's just a typo when you type 160, but yeah, it's all related to 260. Okay, cool. So we'll go back to PayPal and discuss this later on. I mean, this is the beauty of having the trades running in the account, so we can have these conversations. And I know it may be confusing. Good news as well is that the recordings are there for you to review. Okay, but again, it's important that you work in that thinking mode. When you think options, guys, in the end, options are so simple in the end. Okay, so simple in the end, because in the end, all comes back to this formula. If you buy a stock and you buy a put to protect it, right? You buy a stock and you buy a put to protect it. So this is equivalent to what? Someone tells me. It's equivalent to what? If you buy a stock and you buy a put. So if you buy a stock, you can make unlimited. But if it falls, you can lose unlimited. But now if you buy the stock and you buy the put, so the put is your protection. So the most you can lose is limited by the put, but the put costs you money, right? So the most you can lose is what you pay for the put, and if it goes up, you make unlimited minus the price of the put. So in other words, if you buy a stock and you buy a put, isn't this the same as buy a call? Isn't it the same? Isn't it? And if buy the stock and buy the put is the same as buy the call, so then you can play with the math, okay? And this I will just leave it as a homework exercise for you to have fun. So now you can say, okay, wait a minute. If I short the stock and you sell a call, so I'm bringing the call from the right to the left, and therefore instead of plus it becomes minus, right? If I do that, sorry, plus, okay, because I made the stock negative. So this is gonna basically be equivalent to buying a put, which is the example that we saw a minute ago on the chart with PayPal. Okay, so it all comes down to this. Okay, so what's a put? A put is like shorting stock and buying a call to protect it. What's a call? A call is like buying stock and buying a put to protect it. Why? Because if it moves your way, you make unlimited minus what you pay for the call or the put. And if it goes against you, you cannot lose more than what you paid for either the call or the put. Okay? Anyway, a little review of, this is actually options basics, okay? Even though it's often very confusing when people think about it, okay? So from time to time, I'll do little snippets of things that you need to know, little reminders. We learn through repetition, okay? And while it's very good to work on risk profiles, and we should, and we do all the time, it's certainly very important as well to sometime bring in a little bit of these theories, because these theories will help you to quantify the risk. For example, if I ask you, is it a big deal if you get a sign at 260? Well, you know, most people, just because I use the word assign, will be like, oh yeah, it's very dangerous. Well, now you know, the only really negative impact is that you need more money tied up in your account to be there, because to be short 100 shares of stock at 260, you need to come up with, you know, that would be what, 26,000, and if you do it on margin, it's half of that. So you need at least $13,000 to be able to do that. So there is a margin impact. That's the negative part. But from a risk point of view, no risk. Okay, no risk at all. Okay. Siderman, I'm reading you, my friend. Anyway, so let's continue. Let's continue. By the way, this dropped to 259. So let me review one more time. Maybe it's time to roll. 259. So now that means that the extrinsic value is 137. The theta is 75. Here we go. We got it. 75 times 2 is 150. 150 is more than 137, which is the most you could collect. Is that making sense? So time to roll. Time to roll. We now have distorted Greeks on PayPal. So let's go ahead and roll. Create, analyze a rolling trade. Create a rolling order. Okay, 28, 4th of June, plus minus 260, call, 231. Let's do it. Okay, so I'm just gonna go for it. Confirm and send. I'm sending the order now to roll, because the fact that the stock went down, okay, made the delta to be much less, and because delta is less, extrinsic value is less, and because extrinsic value is less, now the theta is distorted. Okay, so so it's time to roll that unit on PayPal, and so if I do it on TradeStation, let me see what's the real-time price for that. So if I do, let me just pick anything, analyze. I'm just gonna select a vertical just it's not a vertical, okay, but I just want to make it a custom. So if I get the 28th and the 4th of June, and it's all calls, and I do 260, 260. So how much is the midpoint? It's 230, okay, 228, okay, 230, 228. I am, how much I am willing to pay? 231, so I should be getting filled. Again, I'm just gonna push it a little bit because I wanna get it filled for educational purposes. If I was to do this in my account, I would be a bit more patient here, okay, unless in order to get a better price. I'm gonna try 235. Oh, sorry guys, it's a credit. I just got confused for a minute. So I should go lesser. That's why I was not being filled. Cancel, replace, it's a credit. So let's make it, I'm just gonna go 225. Confirm and send. Here we go. We just got filled. We got filled at 229. Okay. In the simulated account, 229 is what we've got. Okay, on PayPal. So if you look at PayPal now, okay, you have 4th of June, 4th of June, 16th of July, 16th of July. So we are back, you know, for the next week, at least until Wednesday or Thursday. We are now in this position, and basically we're just gonna leave it alone, okay? But to understand what we have now, team. Yeah, that was for team. Okay, we are working on PayPal now, Siderman, okay? This is PayPal, not team, okay? So, yeah, so back to what I was saying. Now we need to understand what we've got in our hands. Okay, so what we've got in our hands is that basically we have done a roll, and the roll has helped us to collect $2.29 additional to what we had before. So how would that look like if we were to simulate that now? So I'm gonna go ahead and duplicate what we had. Okay, so I got 2 custom. Okay, I'm gonna uncheck the custom above, and with the custom below, I'm just gonna change everything to be June 4, okay? And on the price, okay? On the price, okay? So when looking at the price, remember yesterday we were using this particular value, which is 1141, okay? So this is up to date, the cost of our double calendar after the initial first roll that we did yesterday. We just did a roll now, which has added $2.29 additional, meaning that that cost is diminished by 2.29. So the cost of this trade is 9.12. So if I come here and I type 9.12, now we can re-examine the trade that we have. This is a trade now where we got $29.50 of profit so far, even though in here on TOS it shows minus 117. That's not the case because we have collected profits before. So if you were to add all up, we are netting $30 of profit, okay, at current price. Now, if that stock goes up or down, as long as it stays above 225, again, looking at the chart, 225 is more or less here, okay? And as long as the stock stays below 265, okay, which is the crossing point of the 0 line and the blue line, 265. So 265 is about here. So as long as the stock stays in that range, we will end up in a profit for sure, okay? Now, you may say, wait a minute, the range you have on the chart is wider. Yeah, it is wider indeed, okay? But it doesn't matter because, again, from now until July 16, next week we're gonna roll and collect, you know, maybe another $100, $200. The week after we're gonna roll, collect another, you know, $100, $200, and every time we're gonna be dropping and dropping and dropping and dropping the cost of that trade, and therefore the range is gonna be widening, giving us a greater probability of profit at the end. In parallel, the real bet is that take a look at the chart the way it is. Okay, here it shows the peak of profitability, maximum 301. So take a look at this, okay? As earnings approach, let's say volatility rises by 5 or 10%. So if I do that, what just happened? Well, now that peak is 800 over dollars, okay? And the range has widened so much more now as well, okay? Now the crossover point on the top is more like 277 instead of 265. So again, we are playing, catching that increase of volatility that should happen as we are traveling in time towards the earning date. And in parallel, each week we're gonna be doing those tweaks, those rolls, to lock in some additional profits, which lower the cost basis of the trade and therefore the risk. If you recall, this trade started as a 1,000 over dollar risk trade. Right now, the maximum you can lose on this trade is 912. Okay, that's the maximum you can lose. And again, it's almost a guarantee it's going to be less than that, because again, from now until July 16, we're going to do so many more rolls that will lower the cost each time. Okay, so we are doing what we are supposed to be doing, and I'm glad that we were able to do it together, so you don't have to do this alone tomorrow. I see that Maca, you got filled at 232, very nice price. Ahmed, this is a good idea. By the end of this trade, we will end up making dollars and have profit. It's looking good, Ahmed. I mean, if the stock was to go bankrupt and goes to zero, then no. we will then lose money. Okay, so crazy things could happen, but you know, in normal cases, it's definitely looking good for the trade to be profitable. Okay, last one. Many details to be shared, guys. Okay, so today it's a mix between trading and lecture. Okay, sometimes it has to be like that. So we have AMD, which this one there is very little to comment because this trade was put in place yesterday. If we look at AMD at the moment, it shows as minus 14. Okay, and this is because really not much time has passed, not much volatility has increased, not much movement has happened either. We suffer the bid ask spread of four options contracts when we enter, and therefore it shows minus 14. But really, it's a totally normal beginning in this particular trade. Okay, I'm just really I'm looking at, you know, the very low values for both the call and the put. Let me check. I mean, this would be extremely rare that we see distorted Greeks on June 4 expiration, which is expiring next week, but maybe we do. So let's take a look. So it's the 70 put and the 85 call. Okay, so 85 call has extrinsic value of 6 and theta of 2. So we have distorted Greeks. So that's not a very common thing, but we're gonna have to do a roll here. And the other one I said was the 70, I believe. Yeah, 70 put. So the 70 put is providing extrinsic value of 6 and theta of 2, same story. So it's distorted Greeks because from now until next Friday you got 8 days. So 8 times 2, okay, equals 16 cents, but the most you can get is 6. So it's distorted Greeks. Okay, so again, it was a little bit of a scalp, if you wish. Let's take a look at what's happening on the next expiration date. If we do 70, that's gonna pay 16, and theta is 2. So 2 times 8 is 16, so that's fine. And 85 has an extrinsic value of 19. Theta is 3. So 3 times 8 is borderline, but you know, I would say it's good enough. So yeah, so guys, let's do a roll. And actually we need to do a roll. I was not expecting that one for today, but we're gonna be doing a roll using June 8 for both the call and the put. Okay, so sorry, not June 8, June 11. I'm not sure how I came up with June 8. There is no June 8 Friday, it's June 11. So 4, 11, 70 puts, that's gonna add 10 cents. Okay, it's extremely limited amount of premium. How did I see that again, Maca? Yes. So did not get filled yesterday, Christian. Would you still rather close the call tomorrow night? Yeah, because if you don't close the call, you're gonna be assigned if it's above 260, isn't it? So yeah, definitely. rolling is a must, okay, based on the trade management rules. So how did I do the math, Maka? Yeah, so we got 8 days to go on June 4. We are looking at the 70 put, right? The extrinsic value is 6 cents. So that means that this is the most you will make from that option. Okay? That's the extrinsic value, 6 cents. And theta is 2. So this is how much you make per day in theory. So if in theory you make $2 per day and you got 8 days to go, times 8 equals 16, right? So theta tells you you're gonna make $16 until next Friday. And the reality is that the most you can make is 6. So it's distorted Greeks. How I saw this on the P&L? Oh, no, I just noticed on the P&L you cannot see this. You have to look at the option chain, Maka. I just saw that the mark price was 5 cents only for those options. Okay, that's very, very low. And obviously we got filled at 7 cents and 10 cents yesterday, so it's actually reasonable. But we don't often see the options trading so low just after 1 day of being filled. So when I saw that, I'm like, okay, let's go ahead and check the option chain because Greeks may be distorted. Okay, so that's why. It's just because I saw 5 cents. Okay, but 5 cents is not enough information for me to know I need to roll. I then need to go to the option chain. Got it. Good one. Very good one, Maka. So anyway, so we are doing the roll. Okay, we are doing the roll. Let me take a look at this again. I'm a bit undecided here. Okay, so if we do June 11, this is fun, isn't it, my friends? This is a fun way to say I'm driving you crazy, which probably I am. But anyway, this is powerful too. Okay, so it's worth it to put a little bit of focus here. And by the way, when you do it yourself a few times, it becomes muscle memory. Okay, so it's important that you understand what I'm doing. But basically, I'm looking at June 4 again. June 11. When I look at the 85 call, it has a theta of 3. So 3 times 8, it's 24, where the extrinsic value is 19. So again, technically, the Greeks are distorted. Okay, the Greeks are distorted. Okay, it's fun, Maka. Love it. So the Greeks are distorted on the call, not on the put, but they are on the call. So I'm not feeling very comfortable that the call is already distorted and the put, may be distorted too. And the one thing I'm feeling even less comfortable is that if I put the trade there, it's gonna cost me 10 cents, which when I pay commissions, basically, I'm just spinning my wheels. I'm going nowhere. So I'm gonna evaluate what if I roll from 4 to 18. I'm going to skip 1 week. If I roll from 4 to 18, I'm going to collect 30 cents. Okay, 30 cents from the put. And the 85 call would pay me 38. Okay, which is, I would say, much more reasonable as an action to take. So we're going to do that, guys. We're going to skip 1 expiration date, given how cheap those options are. So we're going to use, June 4 and June 18. And if we do that, it's going to be 25 cents the net, okay? By closing the June 4 70 put and selling the new June 18 70 put, we're going to net 25 cents. Okay, so we're going to do that. I'm going to place the order. Okay, and I'm going to do it again for the other side. Okay, so we just did the put. Okay, you can see here, we just did the put side. Okay, so now we're going to do the call side, and the call side, it's that one here, the 85 call. We're going to right click to create a rolling order, and we're going to roll from 4th of June all the way to 18th of June. We're skipping 1 expiration date, and that would collect us additional 31 cents. So confirm and send. Okay, so let me show you again what I've done. Maybe you want to take a screenshot, guys. I just got filled in one. I got filled on the call side. Okay, so I am rolling the put from June 4 to June 18, and here on the top you can see it's already done. I rolled the call already from June 4 to June 18. It's 85 call in both cases and 70 put in both cases as well. You may want to take a screenshot. Not sure if that's needed or you followed me, but just in case, I'll wait a second and I'll take a sip of water. Ahmed, honestly, we're very lucky learning and trading with you. You are very good. Oh, you're very kind, Ahmed. You know, you just made my day, my friend. Thank you so much as well, Maka. I mean, it's what a pleasure. You know, I love this so much. I would spend hours just, you know, doing this with you guys. And on top of that, you give me compliments. So you guys are the best. Thank you so much. Let me try to get I'm just going to ask for a little less credit, okay? Just so I get this field. Again, with a real account. Be patient. I just got 24. Okay, so that's it. That's what I wanted. So we can continue. Okay, so I got for the puts, I got 24. Okay, for the puts, I got 24, and for the calls, I got 32. Okay, so 24 and 32. That's what I got. Okay, so 24 plus 32. That's what I got. So basically, that's $56 in. Okay, $56 in. So what happens to the risk profile of this trade now? Well, we were in that position. Okay, we were in that position where this trade cost us 204. This is the cost of the trade. Actually, this I never locked in the cost of the trade. That's my bad, actually. Yeah. What about, I ask you guys, I believe that some of you took this trade with AMD. I just forgot to lock in the price, okay, which is what I normally do so we can review. I forgot. Anyone remembers how much you paid for it yesterday when we entered? And if not, I can go back and look at the historical fields. But just to avoid that and save a little bit of time, if anyone remembers how much you got, I'm going to use your value. It was 216. Thank you so much, Maka. I love it because you're always on top of managing those trades and how much you got and how much you paid and your risk. This is fantastic. For you, 218. Look at that. Amazing. 218. Now, by the way, now that you say that, I do remember. So very well said, Maka. Thanks for that. So I got 218 on the top, okay? 218 on the top. So in other words, if I look at yesterday, that was the risk profile yesterday. The most you can lose is 218. What just happened now? What just happened now is that we changed this to July 16 and June 8. Okay, and June 8. And we collected $56.56 additional to what we got yesterday. So our 218 is now diminished by 56 cents, meaning that the cost of this trade now is 162. Okay, so 162 is the new cost of the trade, and therefore if I simulate it, so now you can see the most you can lose is 162. Okay, and again the range has widened a little bit from here to here, and again we are still in a position where if volatility increases, which is the whole bet, okay, the whole bet is volatility increases. So now we are, depending on where we're in the range, we're gonna make, here in the middle like $40 or so. Here we're gonna make 200 something. So again, depending on how much volatility kicks in. And again, for next week, I don't think we have much more to do here because we just rolled all the way to June 18. But the week after, we will roll, and the week after we will roll, and all the way to July 16, and we keep shaving and removing risk while we keep exposing ourselves better and better for a profit, especially when volatility explodes. Okay. You got filled at 24 and 32. Very good. Very good. Very good. Very good. Yes, it was. I remember. I used the market orders so we can get it there for our practice. Wow, what a session today, my friends. It's been the whole hour with trade management, to be honest. But at the same time, quite rich actions. I love it, to be honest, because my little fear, to use a word, fear maybe too big as a word, but my little fear here is that maybe during the week there is some action to be taken, and we meet on Wednesdays and Thursdays. So maybe now you are left, by yourself, and you are like, what do I do now, right? So I love it when we get to do it together. I need to clear my throat. Give me 1 second, please. Very good. Maca, when mark price is the same as my limit, I still don't get filled. Why that would be the case? Yes, because mark means the last trade that took place. It doesn't mean the price of the bidders. It doesn't mean the price of the askers. For you to get executed, they need to take the other side, and then a new last will print. But the last, which is the mark, it's the last trade that took place, and therefore it doesn't mean that you're gonna get filled at this. It's just like when you trade futures, Mark. I'm not sure if you have traded futures before, but like when, let's say, you want to buy the S&P, at whatever value, and price comes to that very same value, and you see the S&P touch the line on your chart, and you're like, why am I not getting filled? Well, it needs to go 1 or maybe 2 ticks, depending on the market you trade, below that line, so now you get filled. Because what you see on the chart is the last. But for you to get filled on a buy order, the ask price needs to meet your entry price, and the ask is always above. So, your price needs to go below the line, so the ask touches the line. And when the ask touches the line, that's when you get filled. Okay? So, mark is not bid or ask. Mark equals to last. I agree, Joan, but it is so great learning how to reduce the risk of the trades rather than just accepting a loss with a stop order. Yeah, especially with options, stops. You get the slippage, and if you get stopped out right at the open, you get tremendous slippage. It's just ridiculous. If you do it with SPY, so maybe you can survive that, okay. But you got 9,000 stocks in the U.S. market. About 2,000 are optionable. It's no way you can use stops on all those securities. It's maybe 5 maximum would be okay to use stops. The other ones are not. Okay, so certainly. And by the way, one more comment, since today we are kind of like more in lecture mode than in trading mode in the end. One more comment I will add is that the beauty of doing the rolls, okay, and I see, Christian, that you say love the rolling concept, okay. One of the beauties of doing the rolls not only is that you diminish the risk, which is certainly a very nice benefit, but it's also you increase the potential for profit. Every time you roll, then your profit is going to be more than if you didn't roll. Okay? Assuming the trades end up in the range and so on. So in other words, it's kind of like, if you think of a trade where if I was to draw it, and a classical plan would be, this is my entry, below is my stop, and here is my target, right? So it's a classical way to manage risk is trail stop, trail stop, trail stop, trail stop, right? So that leaves the target in the same place, right? So that's not what we're doing here. We are diminishing the risk, which is kind of like trailing stop, but every time you are trailing stop, you are also moving target. So you are positioning yourself to make more money as well, so which is powerful. Again, the very sensitive thing here is volatility has to rise. If volatility doesn't rise, we will end up in a profit, but it's going to be moderate. To have these very nice profits that sometimes is like, wow, then you need that increase in implied volatility. That will happen as earnings approach, which we still have a while until getting to July. So right now it's time to kind of like, it's like, you planted the seed, and now the plant starts coming up, and now it's time to start putting those, little sticks to make sure that when the plant grows, it grows straight. So this is where we are at now. We are with the little sticks, okay? And then we will collect the fruit later on. And it will depend on the sun, and if it rained too much or not, and then the fruit will be greater or lesser. It's kind of like a valid analogy for you to think of this. And certainly those analogies hopefully help you, because this type of trade is not for everybody. It requires patience, okay? The beauty is that the consistency you get is normally pretty decent, but it requires patience to keep massaging the trade until now the trade is going to pay you. Now, you work on, as I said many times, you do, let's say 2 or 3 of these per week, and every one of these lasts multiple weeks, you may end up managing 20 trades like that at the same time. So, at the end, you are producing very decent results out there. So it's certainly a very valid way on how to trade. I personally love it, but it requires that patience. And therefore, understanding that concept, maybe you think about the plant analogy, and that helps you to be patient as you are waiting for that explosion of volatility, okay? Yeah, 2 days a week is great. Yeah, a couple of days a week, 3 days a week, depending on how active you want to be. But it's good to take it easy. So anyway, my friends, we spent the whole hour and we didn't put a trade in place. But today is one day where I feel okay with that. There are times where the market is difficult and it's difficult to find the opportunities, and then I always feel terrible because I want to give you materials for you to practice. It's not about being greedy, but it's about giving you materials for you to practice and learn and see and visualize and stuff. But we have 4 trades running, so I guess that those 4 trades are providing nice experiences, nice opportunities to talk about all those different tweaks and roles and everything else and managements. So I think the session today was quite rich because we discussed even something that is often kind of like a mental block, when people get assigned on an option and, oh my God, what's going to happen now, and all those things. So again, of course, if you get assigned and you're naked, it's a problem. But if you have a call to offset the problem, so then it's actually not a problem. It's just a margin impact. Okay. So I'm actually feeling pretty good today, even though we didn't have any trade. In the sense that I believe that you guys, I feel that you have learned a lot, and therefore I'm happy about that. In any case, looking forward to finding a few more trades next week. That will be on Wednesday. So I will see you then. And in the meantime, I will say you guys take care. Keep up the good work. And if you have questions, you know where to find us, isn't it? So count on us. Take care, everybody. Be safe, be disciplined, manage the risk. Okay, be a good trader. Take care, my friends. Bye-bye.